basically we are doing standard costing. This is the first chapter that we start with when we are doing costing. What do you mean by costing?
Like deciding a price for something.
Deciding a price for something. How do you decide the price?
Like take into account the expenses and then you add the profit to get the price.
Okay, so do you decide the price first, or first you do the expenses and then come up to a price?
You do the expenses, then you come up to a price.
You first do the expenses and then come up to the price?
Yeah.
So suppose if I want to sell something, okay, if I want to sell something, would I estimate the expenses, put the profit, and then put the price and then start manufacturing? Or first I will manufacture, then I will sit to find out the price, then I will add the profit and then market it?
No, the first one.
Okay, so that means in costing, what do? You estimate your expenses, right?
Hmm.
You estimate that these are the expenses that you are going to incur. In that, you are going to add your profit and you will derive at a selling price. Yeah? So when you
Yeah.
estimate your expenses, you are actually finding out the standard expenses.
Yeah.
So when you estimate your expenses, you are actually finding out the standard expenses, and this process of finding the standard expenses or estimating the expenses is called standard costing.
Okay.
Okay? So when you estimate the expenses of your production process, the costing that is called, it is called standard costing.
Okay.
That means you will estimate your direct material.
Hmm.
Yeah. You would estimate your direct labor cost.
Hmm.
You would estimate your factory overheads also.
Yeah.
That means you're going to estimate the direct material cost, your direct labor cost. You're going to estimate your overheads cost.
Hmm.
This is predetermined. Yeah,
Yeah.
these are predetermined expenses. So whenever you are estimating, you are actually trying to find out your standard cost. Are you with me?
Okay. Yeah.
But what you actually incur is called what?
The actual cost.
Actually incur, the actual expenses that you incur is called the actual cost.
Hmm.
Okay. So your standard cost may be more than the actual cost.
Okay. Yeah.
Maybe, I'm telling maybe. Or
Hmm.
it can be less than the actual cost.
Yeah.
Sometimes your standard cost may be less than your actual cost. Sometimes your standard cost can be more than your actual cost. And
Yeah.
sometimes your standard cost can be equal to your actual cost.
Hmm.
When it is equal, there is no problem.
Hmm.
But when it is different, that means there is a variance.
Hmm.
Okay, so in standard costing, we are actually trying to find out the variance between your estimated cost and your actual cost.
Hmm.
What is variance?
The difference.
Difference between what?
The standard cost and the actual cost.
So standard cost variance is the difference between standard cost and actual cost. So can you tell
Yeah.
me what is standard cost?
Standard cost is the estimated cost.
Standard cost is the estimated cost. And what is
Hmm.
standard costing?
Um.
It is a
It,
technique where you try to find out the variance.
hmm.
It can be a favorable variance. What do you
Yeah.
mean by a favorable variance?
Standard cost is equal to actual cost.
No, when if standard cost is equal to actual cost, there will be no variance. So
Okay.
talking about favorable variance means what?
standard cost is more than actual cost?
If your estimated cost,
Yeah.
if your estimated cost is more, then are you at a favorable position?
Yeah, because your actual cost is lesser, na?
If your estimated cost is more and your actual cost is less, you're not paying. This is estimation. Estimation is just you predict. So if your estimated cost is more and your actual cost is less, that means it is good for you. And if it is good for you, you are in a favorable position. Are you with me? If your estimated cost is less and the standard cost is more,
Then
which
it's not
is not favorable, so that is called an adverse position. What is it called? That means you are in an adverse position. So can you tell me your variance could be in what things? You could have variance in what costs? You could have variance in what costs? Think. Standard what cost? So you estimate your direct material cost, right? You estimate your direct labor cost, yes? And you estimate your overheads. Do you do that or you do not do? Do you do that or you do not do that?
Miss, can you please repeat? Okay.
So you estimate your direct material cost.
Yeah.
You estimate your direct labor cost.
Hmm.
You estimate your overhead cost.
Yeah.
And you also estimate your sales.
Hmm.
You will estimate, right, the quantity of sales.
Yeah.
Yeah. Yeah. Yeah. How many units you will sell? But you will estimate, right? Okay, fine. So in direct material, what are the things that you can estimate? You can estimate the quantity, the standard quantity,
Hmm.
and you can estimate the rate as well. Yeah. For direct material, you can estimate that for 1 unit, you would require XYZ amount of quantity,
Yeah.
but you might end up spending the other amount of quantity.
Hmm.
And you would also estimate the price at which you buy the direct material. So when I am talking about direct material, you can have two types of variances. What are the two types of variances? You can have direct material. You can have your direct material volume variance and you can have your direct material price variance. Are you with me?
Yeah.
Okay, I'm coming again. For direct material, what are the two things that you can estimate?
The volume
The volume
and price.
and the price. Okay, fine. Price or rate, whatever you can say. When I am
Okay.
estimating the volume, that means I am estimating the usage.
Yeah.
So for direct material, you can have two types of variances. One would be the direct material usage variance. What am I talking? Direct
Use.
material usage variance. Another would be direct material price variance. I will come to the formula at a later stage. Okay.
Okay.
Similarly, for direct labor, can you tell me what are the things that could you could have?
The wages that you would pay to your labor.
One is the labor. One would be the rate that you would pay.
Yeah.
Okay, rate.
Yeah.
Okay, other would be
The amount of employees that you hire.
Usage, right?
Yeah, usage.
So the usage would be the efficiency of your labor.
Yeah.
Let's see this. I estimate that one labor would take 1 hour to make a product. This 1 hour is the usage. Are you with me?
Yeah.
Or in other words, for the labor, I could say this is the efficiency. Yes. This 1 hour could be the usage, or in other words, I could say this is the efficiency of the labor. So instead of usage, when I am finding the labor variance, I will use efficiency. Okay. So it would be the direct labor efficiency variance, which is nothing but the usage or the volume variance. And it can be the direct labor rate variance. Are you with me?
Yeah.
There could be variance in one more thing. Fixed overheads. Can you give me two variances that could happen in the fixed overheads?
First will be the rate.
But you estimate something and it happens something. So it would be, one would be the rate, but fixed overhead cannot be rate, right? So instead of rate, I will write expenditure. So it is fixed overheads expenditure variance. And instead of usage or efficiency, what will I write? Fixed overheads volume variance. Are you with me?
Yeah.
Okay, fine. We need to understand these names properly. For direct material, on first variances would always be the usage, but we use different names. So it is direct material usage variance, direct labor efficiency variance, fixed overhead volume variance. Can you please repeat it?
So direct material is usage.
Variance.
Usage variance. Direct labor is efficiency variance. And fixed overheads is volume variance.
So this variance is actually related to the quantity. Okay. This variance is actually related to what quantity? Are you with me?
Yeah.
The first variance that I'm talking of is always related to what? Quantity.
Yeah.
Now for direct material, the rate, let's talk about rate. Direct material, direct material price or rate variance, direct labor rate variance, and fixed overheads expenditure variance. Are you with me? Are you with me?
Yes.
Okay, fine. Now let's come up to the formula. It's just formula based. Direct material usage variance. That means standard quantity minus actual quantity would give me the variance.
Yeah.
Yeah. Multiply with this arrows you should remember SRAQ, SRAQ, SRAQ. Are you with me?
What is a standard
Standard rate,
and actual rate?
quantity. Standard
Okay.
rate, actual quantity. Standard rate, actual quantity. Are you with me?
Yes.
Okay. Direct material usage variance, the formula is
Standard quantity
minus actual quantity multiplied by the standard rate.
So this is to find the variance in the usage.
In the usage. So direct material usage variance. Can you give me the formula for direct material price variance or rate variance?
Standard rate minus actual rate.
A minus actual rate multiplied by
the standard,
Actual
no,
quantity.
okay,
Okay. So that is why we remember this. On top usage, below rate. Usage rate. Usage rate. And SRAQ, SRAQ, SRAQ. Are you with me?
yes,
Okay, fine. Now come on, name this first variance.
direct labor efficiency variance.
Efficiency means what? Quantity. Efficiency means what?
Quantity.
Come on, give me the formula.
Standard quantity minus actual quantity.
Standard
Into
quantity minus actual quantity
SR.
into standard rate. So here the quantity would be what?
The efficiency.
Means what? Quantity for labor is what?
Per hour, how much?
Hours.
Yeah.
Quantity for labor is what? Hours.
Hour.
Now
Okay.
could you give me the formula for labor variance?
It's going to be
Direct labor rate variance.
yeah. So the standard rate minus actual rate into actual quantity.
Yes.
Okay.
Okay, fine. For fixed overheads, I will come back again. Let's see your knowledge about sales.
Okay.
What variances could you have in sales?
Save like the amount you thought you would sell.
First would be
Volume.
volume variance.
Hmm.
Second would be
The price.
price. Volume is the quantity. Volume is the quantity. Price
And
is
price.
the rate. Okay. Multiplied with what? Here multiply with what?
SR.
Here multiply with
AQ.
AQ. Okay, fine. Formula. Sales volume variance. Can you give me the formula?
Standard quantity minus actual quantity into standard rate.
Very good. Sales price variance. Can you give me the formula?
Standard rate minus actual rate into actual quantity.
Into actual quantity. Very good. Now we come at a step where we have to decide whether it is adverse or favorable. Okay. Let's talk about sales volume variance. Standard quantity. I decided to sell 10 units. I sold 15 units. Adverse or favorable?
Favorable.
I decided to sell 10 units. I sold 15 units. Adverse or favorable? Favorable. So it is favorable. You will not take the minus sign into consideration. Okay. It is favorable. Are you with me?
Yeah.
Come on. Sales price variance. Let's look over here. I decided to sell at 8. I sold at 6.
Adverse.
Adverse.
Yeah.
Sign of the bracket you don't take. This bracket SR minus AR or SQ minus AQ is only used to decide favorable or adverse.
Okay, so you don't actually.
Yeah. Now usage variance. I decided to use 10 units, 10 kgs. I used 5 kgs. You
So
decided
that's
that you would use 10. Used 5. Favorable. You use less quantity. Good.
yeah, it's favorable.
Use more units, more kgs to produce a unit. You use less kgs. Favorable. Now price. You thought that you would buy the raw material at 8. You bought at 2. Favorable.
Favorable.
Okay. For labor, efficiency. You thought it would take 3 hours, it took 4 hours. Adverse.
Yeah.
Yeah. You thought
Yeah.
you would pay 8, you paid 20.
Adverse.
Adverse. Fixed overheads. Now, fixed overhead expenditure variance, you will just remember MA. Now, these are my techniques to remember the formula, okay?
Okay.
That is fixed overhead as per master budget minus fixed overhead as per actual budget. I will come to this.
Okay.
What is master budget? What is actual budget? Okay.
Okay.
Now, first, I want you to digest these words, write down the formula. You can go to page 6 of the PDF that I have shared with you. There I have made the boxes. I want you to write down these formula, memorize, and then I can take you to master budget, flex budget, and actual budget. I'm giving you some time, digest it. I will wait for you. Okay. So you are only studying 4 variances in this chapter. Sales volume variance, sales price variance, direct material usage variance, direct material price or rate variance. Okay. What else you're studying? Direct labor efficiency variance, direct labor rate variance, fixed overheads volume variance, and fixed overhead expenditure variance. So we are learning these 4 variances, and I have given you direct formula. For volume, you will always put standard minus actual, but the volume, quantity.
Yeah.
Multiply with SR. SRAQ, 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 SRAQ. If you go through this structure, you will never forget your formulas.
Okay.
Tell me 4 variances that we have to find out in this chapter.
Sales, material, labor.
Material, labor, and overheads.
Okay.
Okay. For sales, it is what? Sales, volume variance,
variance,
and
and
sales price variance. Are you with me?
Yeah.
For material, it would be material
Usage variance,
and material
rate variance.
price or rate variance. For labor, it will be
Efficiency variance,
and labor
rate
rate
variance.
variance. Okay, for fixed overheads. Now look over here. Here you need to understand very properly. For fixed overheads, you would have the fixed overhead volume variance and fixed overhead expenditure variance. When I'm talking about fixed overhead expenditure variance, you will remember the word MA. M-A. It would be fixed overhead as per master budget minus fixed overhead as per actual budget. What is master and actual? I'm coming to it. Okay. For fixed overhead, which variance I'm talking? Expenditure variance.
Yeah.
And for fixed overhead volume variance, it would be standard quantity minus actual quantity. But instead of the standard rate, you will multiply it with the overhead absorption rate. Okay. How do you get OAR?
Budgeted activity level upon actual. No,
Think
what was it?
you get overhead absorption rate?
It was a budgeted activity level upon overheads.
Budgeted overheads.
Okay, ulta.
Budgeted overheads divided by the budgeted activity level. Okay. So this is how you get your OAR. So everywhere for volume variance, you're going to multiply it with the standard rate. But only for the fixed overheads, instead of the standard rate, you are going to take the overhead absorption rate.
Okay.
Are you with me? Now I am going to teach you 3 things. What is a budget? Can you tell me what is a budget? A limit or your estimate.
Hard-earned money.
You estimate something. Okay. So there is one budget which is called the master budget. What is it called?
Master budget.
Master budget is something that gives you the standard cost. What does it give you?
Standard cost.
When I am talking about the standard cost, that means you have the standard rate into the standard quantity. Are you with me?
Yeah.
So standard rate into the standard quantity is going to give you the standard cost. Standard cost for standard production. This is your main budget. This is your master budget. Are you with me? The second budget which we have is called the flexed budget. What is flexed budget? I estimate to produce, say, 100 units. Okay? At the rate of 2 per unit. So my standard cost is 200. Are you with me?
Yeah.
But when I prepare a flexed budget, I just see what is the difference in the cost for actual production. So when I flex the budget, I actually try to match my standard rate to the actual quantity produced. That means flex budget is the standard rate for actual quantity. I flex the budget based on the actual number of units that I produced. Okay, so my standard rate would be 2. My actual quantity, say, is 50 units. Okay, so my as per the flex budget, based on the standard rate, my cost would become 100. Are you with me?
Yeah.
The third budget that we have is the actual budget. What is the actual budget? Actual budget is actual rate for actual quantity. Okay, are you with me? Okay, so when I am doing variance analysis, I only do the analysis between the rate.
Yeah.
Okay, so when I am doing standard costing, I always compare my standard rate with the actual rate.
Yeah.
For actual quantity. So one is the budget that we prepare is the master budget. What is master budget? What is master budget? Standard costs or standard rate for standard quantity.
Yeah.
Okay. But what I expect to produce is not material. What I actually produce, that is important. Right? So what do? I flex my budget based on the actual quantity that I produced. So flex budget is what? Flex budget is standard rate
into actual
quantity.
Yeah.
Okay. And actual budget is what? Actual rate for actual quantity. So when I want to do variance analysis, I do a comparison between my flexed budget and the actual budget. Are you with me?
Yes.
But only for my fixed overheads. Only for my fixed overhead expenditure variance, I compare my master budget with actual budget because fixed overheads are fixed irrespective of the quantity that I produce. That is why I say that for fixed overheads expenditure variance, we compare our fixed overhead as per master budget with the fixed overhead as per actual budget. Why do I do this? Because fixed overheads is something that remains fixed irrespective of the quantity that is produced. So I don't need to compare the flex and actual. I will compare the master and actual. I'm giving you some time to digest, write, learn, ask questions. I will entertain you, but you should be very clear. Variance analysis is an analysis between which budget? Flex and
Master. Okay.
okay.
The variance.
Standard rate is compared with the actual rate
Yeah.
for actual quantity produced.
Hmm.
And what you prepare at the initial stage is called your master budget, where you don't know the quantity, you don't know the actual amount, you just estimate the rate and you estimate the quantity. Then you flex your budget based on your estimated rate. You flex
Hmm.
the budget to your actual quantity.
Hmm.
And you compare flexed with actual, giving you time, digest it. Now, this is a question. Now, you have to answer this one thing to me. What have they asked you to find out? What have they
Calculation of
done?
cost.
Which costs?
Labor
Labor
cost.
costs.
Labor cost for standard production. So, can you tell me which budget is this? Master, flexed, or actual?
Master.
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 Anything for standard production will always be which budget?
Master.
Master.
Master budget. What have they asked you to find out?
Standard material cost for standard production.
Which budget?
Master.
Master.
Master budget. So they want you to find out the standard labor costs and they want you to find out the standard direct material costs. Okay. So standard rate into standard quantity would give you this cost. So they are asking you to prepare a budget for direct labor cost and a budget to find out the standard material cost. I want you to read the question, try to apply what is there, and then we will discuss it. Okay, so what is the first thing that they want us to find out?
Labor
Standard
cost for standard.
cost for standard production.
Hmm.
Okay, what is your standard production? You make desks in 3 sizes, correct?
Yeah.
Small, medium, and large. You are expected to produce 200 small desks, 300 medium desks, and 400 large desks. This is your standard production.
Hmm.
Are you with me?
Yeah.
To make this standard production, you need standard quantity.
Hmm.
That means you want your standard hours.
Yeah.
Are you with me?
Yeah.
To make small desks, you need 30 minutes. Yeah.
Yeah.
Medium, you need 1 hour.
Hmm.
And for large, you need 1.5 hours. So your standard quantity is nothing but your standard hours for standard production. Please note your standard production is 200, 300, and 400 desks. Are you with me?
Hmm.
So this is your standard quantity for standard production. What is your standard quantity for standard production? So you will multiply it. So you're going to get 100, 300, and 600. Your standard quantity for standard production is 1000 hours.
Hmm.
Are you with me?
Yeah.
Now let's go on the rate. What is the rate? Per hour rate is 15.
Hmm.
Yeah.
Yeah.
So your standard cost is made up of standard quantity for standard production. I am again and again repeating it. It is standard quantity for standard production multiplied by the standard rate.
Hmm.
So standard costs is standard quantity for standard production multiplied by the standard rate. So this becomes 1500, 4500, 900. Your standard cost for standard production is $15,000. Okay, please remember this. Okay, it's 15,000. Sorry, 9,000. 4,500 plus.
Which is 15,000 only.
Okay, fine. So it's 15,000. I am repeating one statement again and again. It's not out of habit of repetition. I want you to remember this. This is standard quantity for standard production. Multiplied by the standard rate is going to give you the standard cost. Okay, and this is which cost? Standard labor cost. Are you with me? Come on. Now, standard material cost for standard production. Can you please read this, Ashita, for me?
Yeah. Calculate the standard cost.
The tests are made
The
from
desks are made of firm wood. The standard price of the wood is $20 per meter. Study Limited has set its budget fixed overheads at 50,000 per month, which are absorbed on the basis.
I want to find the material cost. How will I find it? They have already given me the standard quantity. And they have given you the standard quantity that you need per unit. So standard quantity for standard production is how much? Standard quantity for standard production is how much?
400.
400, yeah.
Then 900.
And then 1600.
What is your standard rate?
20 meters.
20 per meter. So what is your standard material cost? Can you tell me the formula to come at standard material cost? Standard quantity, I wanted to repeat this. Standard quantity for standard production multiplied by standard rate. I've written also.
Yeah.
Okay. So can you give me the standard material cost? Standard quantity for standard production multiplied by the standard rate. So it is going to come up to 8,000 plus 18,000 plus 32,000. So it's 58,000. Are you with me?
Yeah.
This is the direct labor cost. And this is the direct material cost. And this is as per which budget? As per which budget?
No, this is master.
Master.
Yeah.
What makes you say this is as per master budget?
Because it says for standard production.
Standard production and standard cost or standard rate. Yeah? Are you with me?
Yeah.
How do you calculate the overhead absorption rate?
Overheads upon budgeted activity level.
So budgeted overheads divided by budgeted activity level. Can you tell me the budgeted overheads? Can you tell me the budgeted overheads?
Will it be 100 plus 150 plus 200?
Read the question.
Oh, yeah, sorry. It says
50,000.
Okay. It is absorbed on what basis?
Direct labor hours.
So what are the total direct labor hours? What is the total direct labor hours? Check.
1,000.
1,000.
1,000. You need to relate things, okay? What is the
Okay.
total direct labor hours?
1,000.
1,000. So when I am talking about overhead absorption rate, my fixed overheads are how much? 50,000. It is absorbed on what basis?
Direct labor hours.
What is my direct labor hours?
1,000.
Where did you get that from?
From the table.
From the table. So how will you find out the OAR, overhead absorption rate?
50,000 upon 1,000.
Budgeted fixed overheads divided by the budgeted activity level. I am using the word budgeted, budgeted, budgeted. So your overhead absorption rate would be
$3
per direct labor hour. Are you with me?
Yeah.
I want you to finish the budgeted OAR and try to prepare the budgeted profit statement for April. I am keeping this open, but I want you to prepare it yourself.
Hmm.
Okay?
Yeah.
You want to make a budgeted profit statement. Budgeted profit statement is sales minus direct material minus direct labor minus fixed overheads is going to give you the budgeted profit. Okay?
Hmm.
Now your revenue is small desk is 100. How many small desks you are going to sell? 200.
200.
So 200 into 100 for small. Medium it would be 300 into 150.
Yeah.
Okay. And for large it would be 400 into 200. So this is your revenue. Are you with me?
Yeah.
You had already calculated the direct material cost on top.
Hmm.
This. Yes.
Yeah.
And you had already calculated the direct labor costs.
Hmm.
So the direct material cost would be the ones that you had calculated.
Yeah.
Total. Direct labor cost that you calculated total.
Hmm.
Now fixed overheads, you always remember the basis of absorption. You've calculated the OAR and it is
Yeah.
absorbed on the basis of your direct labor hours.
Hmm.
Your direct labor hours is 200 into 0.5, 300 into 1, and 400 into 1.5. You had calculated this above.
Yeah.
Okay, so this is your direct labor hours. So fixed overheads are absorbed on the basis of direct labor hours. So it would be OAR into the labor hours used. Yeah.
Yeah.
So OAR is 50 into 100 for 100 labor hours for small desk. OAR 50 into 300 labor hours for medium desk. OAR 50 into 600 labor hours for the large desk. So this is your
Yeah.
fixed overheads. So revenue minus your direct cost minus your indirect cost is going to give you your budgeted profit, and this is your budgeted profit statement. With
Hmm.
this, we complete our example number 1, and I want you to try the example number 2. This is activity 38.1. It's just like the previous sum. So if you were able to do your previous sum, you should be able to do this. What do they want from you? Standard labor costs for standard production. Can you tell me which budget is this? Master, flexed or actual?
Master.
Master.
Master budget. Ashita, can you please read the question? Start from the question.
Yeah. A manufacturing company uses standard costing for its products, curtains, and sheet. Both use the same materials and are made in the same factory. Estimated production and sales volume for the next 3 months are 10,000 sets of curtains and 8,000 pack of sheets. Standard
Stop,
costing information for
stop,
these products.
stop.
Do I stop?
What is standard production?
The estimate
10,000 sets of curtains and 8,000 packs of sheets.
Okay, 10,000 sets of curtain and 8,000 packs of sheet.
Hmm.
Okay, what is standard hours?
2 and 1.
Standard costing information is given. So for curtains, the standard hours is 2, and for sheet, the standard hours is 1. Now, can you give me standard labor hours for standard production, or I would say standard quantity for standard production?
20,000 and 8,000.
20,000 and 8,000.
20,000 labor hours and
Hmm.
8,000 labor hours. Standard rate, standard rate,
12.
12.
the standard cost, standard labor cost for standard production,
Standard. The total you mean to say?
20,000 into 12.
Oh,
So
12. So
labor cost
240,000 and 96,000.
240,000 and 96,000. So the total standard labor cost is how much? 336,000. Are you with me?
Yes.
Yeah.
Now for material, how much curtains? How many sheets? 8,000.
10,000.
Now material needed for curtains would be how much?
5.
For sheets,
2.
the standard quantity for standard production would be how much?
50,000 and 16,000.
50,000 and 16,000.
No.
Standard rate,
4.
so standard material cost for standard production would be
200,000 and 64,000.
and 64,000. Standard material cost for standard production. Okay. Now calculate the OAR. How do you get the OAR?
Budgeted on budgeted
Overheads
total.
upon activity level.
And it is absorbed on the basis of what? Overheads are absorbed on the basis of?
Direct labor.
Direct labor
So
hours.
you give me the budgeted overheads.
266,000.
6,000. What are your direct labor hours?
28,000.
28
8,000 hours. So OAR is how much?
9.5.
$9.5 per direct labor hours. Are you with me?
Hmm.
Now budgeted statement of profit, how do you get that?
So revenue first.
So revenue, where did you get the revenue from?
You do 90 into 10,000.
Okay. For curtains and for sheets, it would be 8,000 into 40, correct? Yeah?
Yeah.
Now direct material cost is how much? For curtains, it is 200,000. And for sheets, it is 64,000. So 264, correct?
Yeah.
Direct labor cost for curtains, it is 240,000. And for sheets, it is 96,000.
Hmm.
So 336,000. Fixed overheads are absorbed on the basis of direct labor hours. So 9.5 into 20,000. for curtains and 9.5 into 8,000 for sheets. Are you with me?
Yeah.
So this is your budgeted profit.
Hmm.
Yeah. So with this we complete. How do I find out the standard material cost? How do I find the standard labor cost? How do I make a budgeted profit statement? Are you with me?
Hmm.
Can you tell me what is a master budget?
Master budget is when you're like preparing the standard production or something like that.
I have explained and I have made you write also.
Yeah, so it's a standard rate into the standard quantity.
Standard rate into the standard quantity for
Hmm.
which production? For
For
standard production.
standard.
Okay. So do you think that your standard production will always be equal to your actual production?
No,
No. So if your standard production is not equal to your actual production, what do? You will flex the budget. What will you do?
you will flex the budget.
And you flex the budget to which production? Actual production.
Okay.
Ashita, can you tell me the three types of budget that you know?
Yeah. So one is master, then one is flexible, you know. Flex, sorry, one is master, one is flex.
Yeah. And the third is actual budget. Master budget is also called the fixed budget. Are you with me? Ira, are you with me? Hi. Chitla.